We've seen the headlines. We've analyzed the data in previous discussions. China is executing a historic, multi-decade strategy centered on gold. They are accumulating physical metal at a rate unseen in generations. They are building the infrastructure, the Shanghai Gold Exchange, the Gold Corridor, to create a parallel financial system, a system explicitly designed to bypass the US dollar. They are constructing, piece by painstaking piece, a gold fortress to challenge the 80-year reign of the American currency. This is not speculation, it is happening. But this raises a critical, multi-trillion-dollar strategic question. What is the real counter move from the United States? Is America's strategy simply to try and buy more gold than China? Is the answer to China's 21st century financial engineering simply to hoard more of a 5,000-year-old metal? Does that sound like the America that invented the internet, that put a man on the moon, that leads the world in technological innovation? Or is there another battlefield emerging? A battle not fought in subterranean vaults filled with metal bars, but a battle fought on global, digital networks secured by cryptography and advanced algorithms? If China is betting its future on the weight of history, on trust through time, what will America bet on to maintain its global leadership? In this video, we delve into a controversial, yet increasingly plausible strategic scenario. A scenario where the United States, geopolitically cornered by China's gold fortress, may be forced to deploy its most potent weapon, technological innovation. And the spearhead of that technological arsenal might just be the very thing many still dismiss as magic internet money. Bitcoin and the ecosystem of digital assets it represents. Let me be absolutely clear. This is not investment advice. This is a high-level geopolitical analysis of the future of money. We will dissect the fundamental clash between two opposing philosophies of trust and value. We will explore why Bitcoin, viewed through a strategic lens, presents a uniquely powerful counter to China's gold gambit. And we will paint a picture of what the global monetary system might look like after this great monetary reset. The chessboard is being set for the next century. Let's understand the pieces. The core conflict. Trust versus trust. To grasp the magnitude of the shift underway, we must understand the fundamental conflict at its heart. This is not merely about China versus the US. It's about two fundamentally different approaches to establishing trust in a global financial system where the old anchor, faith in the US government's credit, is visibly eroding. Let's first examine China's strategy, trust through time. Why gold? Why this ancient metal? The answer lies deep in human psychology and financial history. Gold has served as money, as a store of value, for over 5,000 years. It transcends cultures, borders, and political regimes. Its value is universally understood, ingrained in our collective consciousness. Crucially, in a world shaken by the 2022 freezing of Russia's $300 billion in foreign reserves, gold offers tangibility. You can see it, you can touch it, you can store it in your own vault. This physical presence resonates deeply, especially with nations and older generations who have witnessed the fragility of paper promises. Unlike U.S. Treasury bonds, gold is nobody else's liability. It carries no counterparty risk. Its value doesn't depend on the fiscal discipline or political stability of another nation. How is China operationalizing this strategy? First, massive physical accumulation. The People's Bank of China has been the world's largest official gold buyer for years, and analysts widely believe their true holdings vastly exceed public declarations. Second, building the infrastructure. The Shanghai Gold Exchange, SGE, aims to usurp London and New York as the center for physical gold price discovery, moving away from the paper derivatives markets. Third, the Gold Corridor. This isn't just about vaults. It's a network designed to facilitate gold-backed trade and lending among BRICS nations, creating a closed loop that bypasses the dollar-based SWIFT system. The underlying philosophy is clear. Build a new system anchored in a historically proven physical asset. It's a system designed to be perceived as stable, reliable, and resistant to Western financial sanctions. It's inherently a state-controlled, closed system. Nations participate, but the core infrastructure and pricing power are increasingly centered in Shanghai. Think of it as China building a gold fortress, imposing, tangible, heavily guarded, rooted in the past, but ultimately centralized and limited by physical constraints. This strategy holds immense appeal for countries wary of U.S. financial dominance, seeking an alternative they perceive as real and beyond the reach of sanctions. Now let's consider the potential U.S. counter-strategy: trust through technology. What has historically been America's greatest strength? It wasn't just natural resources or military might, it was innovation. From the telephone to the transistor, the internet to the iPhone, semiconductors to artificial intelligence, America's power has always stemmed from its ability to invent the future, to build open systems that unleash global creativity and commerce. Indeed, the existing dollar system itself, SWIFT, the Eurodollar market, is a technology-based network built on trust and established protocols. But that system has weaknesses. Its reliance on U.S. government debt makes it vulnerable, as we discussed in our previous analysis. And its centralized control points have allowed for its weaponization, triggering the very de-dollarization movement it now faces. Simply trying to out-hoard China in physical gold plays into China's strengths and ignores America's core advantage. It's like trying to beat a tank factory by building bigger horses. The United States needs a countermove that leverages its unparalleled technological prowess, its culture of innovation, and its preference for open, network systems. Instead of building a closed fortress like China, America's natural strategic inclination is to build an open network. A system that is flexible, global, adaptable, and based on transparent, verifiable rules enforced by cutting-edge technology. This is where the strategic case for digital assets, particularly Bitcoin, begins to emerge. Not as a replacement for the dollar overnight, but as a technological foundation for a different kind of trust in the 21st century. Bitcoin as a geopolitical weapon, the spike. Now let's address the elephant in the room. When we talk about Bitcoin in this context, we need to shift our perspective dramatically. Forget the narrative of buying pizza or speculative trading. Think bigger, think strategically. Think of Bitcoin not as a currency, but as a potential global neutral reserve asset, a digital commodity engineered for a networked world. Like gold, Bitcoin is nobody else's liability. It exists independently of any government or corporation. But unlike gold, it is native to the internet. It is programmable. It operates on a fundamentally different principle of trust. This is trust through math and energy. Let's break down why this is strategically significant. First, proof of work. Bitcoin mining isn't wasting energy. It is the process of converting raw computational power, physical energy, into digital scarcity and network security. This creates a verifiable, unforgeable cost of production, much like the cost of mining gold. But Bitcoin's scarcity, a hard cap of 21 million coins, is mathematically guaranteed and auditable by anyone in real time. Second, the decentralized ledger, blockchain. Every Bitcoin transaction is recorded on a public ledger, distributed across thousands of computers worldwide. This ledger is transparent. Anyone can view it. It is immutable. Once a transaction is confirmed, it cannot be altered or deleted. This eliminates the need for trusted intermediaries like banks or governments to validate transactions. Trust is embedded in the code itself. Third, and perhaps most crucially, from a geopolitical standpoint, censorship and seizure resistance. Remember the freezing of Russia's reserves? That was possible because those dollars were held within the traditional banking system, accessible to Western authorities. Bitcoin, when held correctly with private keys managed by the owner, self-custody, is significantly harder to seize or censor. While governments can regulate exchanges or pressure individuals, they cannot simply reach into the decentralized network and confiscate Bitcoin held in a private wallet without the keys. This property directly addresses the core fear that drove nations towards gold after the Russia sanctions. Now, why does this technological marvel present such a compelling strategic fit for the United States, specifically as a counter to China's gold strategy. Consider the contrast: decentralized versus centralized. Bitcoin's network is globally distributed, owned by no single entity. This stands in stark contrast to China's state-controlled gold reserves and SGE-centric system. It aligns with America's historical preference for open, less centralized systems. Open versus closed. Bitcoin's code is open source. Anyone can audit it. Anyone can build on it. Anyone can participate without permission. This mirrors the philosophy of the open internet, a largely American invention, contrasting with China's more closed, state-managed approach. Technology versus physical. Bitcoin leverages America's undisputed dominance in software, semiconductors, and network technology. Competing on this battlefield plays to U.S. strengths rather than China's strength in accumulating physical commodities. Transparency versus opacity. The Bitcoin blockchain offers unprecedented transparency in tracking asset flows, though ownership remains pseudonymous. This contrasts sharply with the persistent questions and lack of verifiable audits surrounding China's true gold holdings. Beyond these direct contrasts, consider Bitcoin's potential as a new form of soft power. In a world fragmenting into competing monetary blocks, dollar, yuan, BRICS, Bitcoin offers a potential neutral off-ramp. Countries hesitant to fully align with either Washington or Beijing could see Bitcoin as a truly neutral reserve asset, outside the control of any single superpower. Holding and facilitating Bitcoin infrastructure could enhance America's image as a hub for financial innovation, attracting global capital and technological talent. And what about Wall Street? What is the role of the giant financial institutions? Think about the explosion of Bitcoin Spot ETFs in the United States. As of late 2025, according to Bloomberg data, these regulated investment vehicles managed by giants like BlackRock and Fidelity hold over $250 billion worth of Bitcoin on behalf of investors. Is this just speculation? Or is Wall Street, with its deep connections to Washington, building the financial infrastructure, the rails, for Bitcoin to be integrated into the mainstream financial system at an institutional level? Listen to Larry Fink, the CEO of BlackRock, the world's largest asset manager. He speaks repeatedly about the tokenization of everything. He envisions a future where stocks, bonds, real estate, and other assets are represented as digital tokens on a blockchain. He calls this the next generation for markets. Bitcoin, as the original and most secure blockchain network, could serve as the foundational settlement layer, the digital gold underpinning this tokenized future. Is Wall Street simply chasing returns? Or are they, perhaps with tacit government approval, laying the groundwork for America's technological countermove in the great monetary reset? The pieces are moving on the board. The inevitable choice, the monetary reset. The evidence strongly suggests we are leaving the era of U.S. dollar hegemony, the unipolar monetary world that began after World War II. The weaponization of the dollar, coupled with unsustainable U.S. debt levels, has irrevocably damaged trust and accelerated the search for alternatives. But this doesn't mean the dollar disappears overnight. As the IMF and Bank for International Settlements reports indicate, the dollar will likely remain the dominant currency for international trade for the foreseeable future, simply due to inertia in the depth of existing infrastructure. However, its role as the primary global reserve asset is undeniably shrinking. We are transitioning into a multipolar monetary world, a more complex, fragmented landscape where different assets serve different strategic purposes for different global players. What might the roles of key assets look like in this new era? The U.S. dollar, it continues as the main currency for invoicing and settling global trade, but its share of global reserves continues to decline. Crucially, the dollar itself is likely to evolve. We see this already happening with the rise of regulated stablecoins like USDC, which are essentially digital dollars running on blockchain rails, settling transactions globally, 24/7, outside the traditional banking hours. These already have hundreds of billions in circulation. The Federal Reserve continues to research a central bank digital currency, CBDC, a digital dollar though political hurdles remain. Whether through private stablecoins or a public CBDC, the dollar is adapting to the digital age. Gold. Gold reclaims its ancient role as state-level collateral. It becomes the primary reserve asset for nations within the BRICS bloc and others seeking independence from the Western financial system. It represents trust through time, physical stability, and insulation from sanctions. It is the anchor of China's gold fortress. Bitcoin. Bitcoin emerges as the global neutral collateral layer. It's the digital equivalent of gold, but native to the internet. It represents trust through math, verifiable scarcity, and censorship resistance. Its primary holders might initially be non-state actors, corporations, and forward-thinking individuals, but increasingly, nations seeking a truly neutral reserve asset, unbound by the politics of either Washington or Beijing, may add it to their balance sheets. It could also serve as pristine collateral underpinning a new generation of non-national stablecoins or decentralized financial applications. Other digital assets, tokenized assets, other CBDCs, this category explodes. Following Larry Fink's vision, we see the tokenization of real-world assets, stocks, bonds, real estate, moving onto blockchain rails for efficiency and broader access. Multiple countries will launch their own CBDCs, creating a complex web of digital currencies interacting globally. How would this new system function? Imagine a world where international trade is still priced in dollars or digital dollars, stablecoins. However, when settling large balances between nations or when posting collateral for major international loans, countries might use gold within the BRICS system or Bitcoin on the open global network. Central banks would hold a diversified basket of reserves, some dollars, stablecoins for liquidity, gold for geopolitical alignment or deep storage, and potentially Bitcoin as a neutral, digital store of value. It would be a more complex system, certainly, but potentially a more balanced one, less reliant on the political whims or fiscal health of a single nation. The great divergence and the resonance point. The battle for the future of money is well underway. It is a great divergence, a split between two powerful, competing visions for global financial order. China and the BRICS nations are making a calculated bet on the past. They are building their future on the perceived stability and historical weight of physical gold, trust through time. It's a strategy rooted in controlling physical assets and building a closed, state-managed system. The United States, blessed with technological supremacy and a culture of open innovation, faces a strategic imperative. It cannot win by playing China's game. It may be geopolitically cornered into playing its own game, leveraging its strengths in technology and open networks, embracing trust through math and energy, embodied by digital assets like Bitcoin. This isn't merely about finance. It's a clash of civilizations reflected in monetary philosophy, a contest between the closed, centralized fortress and the open, decentralized network, between state control and permissionless innovation. The outcome is uncertain. Both systems may coexist for a long time, but the direction of travel seems increasingly clear. Now that you understand the strategic battle lines being drawn between gold and Bitcoin, you need to see what the major players, the giant institutions, are doing about it. In our next video, we will dissect BlackRock's multi-billion-dollar Bitcoin strategy and analyze what their actions signal for the future of finance in the West. Click the link on the screen to watch that critical analysis next. This historical divergence presents a profound question for every nation, every institution, and every individual seeking to preserve wealth in the 21st century. As we navigate this great monetary reset, where do you place your long-term trust? In the 5,000-year history of physical gold? Or in the verifiable mathematical certainty of digital assets like Bitcoin? There is no single right answer. It is a strategic choice. Share your strategic choice and your reasoning in the comments below.